Hi, my name is Ashish Sinha and I'm a research analyst with Gabelli Funds based at our London office. I'm here today to talk about our best idea for 2023, Unilever. Headquartered in London, Unilever is trading at €46.50 with a market cap of around 119 billion euros. Net debt is 27 billion and including the minorities, total enterprise value is around 172 billion euros. Unilever is a global consumer and food product company with 60% of sales coming from emerging markets. Sales have been flattish over the last 5 years, underperforming global peers. We think this reflects relatively slower organic and volume growth and decreasing brand spending as a percentage of sales. Shares also trade at a lower multiple versus peers. Most recent events, however, have created what we feel are catalysts to help drive re-rating in shares and drive performance in 2023. In early 2022, Unilever made a move to acquire the GSK consumer business, which is now known as Haleon, for around £50 billion. This move was opposed by shareholders and management had to abandon the idea. And in response, they launched a strategic plan to reorganize into 5 business units, reduce 1,500 management roles, and launch a €3 billion share buyback. Later in July, Trian announced a 1.5% stake in Unilever and Nelson Peltz joined the board. In September, CEO Alan Jope announced his intention to retire. Earlier this year, Unilever announced Heinz Schumacher as the new CEO from July. He comes from Dutch dairy company FrieslandCampina and also has been on Unilever's board since October 2022. One of the key drivers for the shares would be accelerating growth, rationalizing the portfolio by exiting certain businesses, and drive margins, or do a combination of these three. At the company's December Capital Markets Day, management expressed this as their midterm financial framework: 3 to 5% organic growth, modest margin expansion, strong free cash flow generation, and leverage to remain around 2 times net debt to EBITDA. While organic growth in the last several quarters has been price-driven and given the global macro, volume elasticity is likely to impact all CPG companies globally, including Unilever. We think they have some advantages, however. Their broad product portfolio covering several price points, and pricing for them is not just list price increases, but rather a combination of actions under net revenue management. Moreover, Unilever is used to dealing with forex-based pricing volatility in emerging markets, and hence we think they can manage this volume elasticity better than peers. The company has got a strong balance sheet and free cash flow generation. Portfolio rationalization is ongoing and they're not going to do any large M&A in the near term. They can then drive self-funded or a portfolio rationalization-led higher brand spending and thus growing while continuing to pay an attractive dividend and do share buybacks. Shares trade at 14.5 times 2023 EV/EBITDA, and with a 3.7% dividend yield and several catalysts, we view the shares as attractive and is a best idea for 2023.